Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that really don't make any sense. If you keep hearing the hammering, no, it's not hammer time. And I thought the roofing would be done by now, but I pushed the video as long as I could. And I swear they put 1 million nails in there, but they got a few more. So as you know, the trade deal is signed and done today. Just so you understand, this is not an official treaty. This is an informal trade agreement. That's why the bill is not going, there's no bill. It's not going in front of Congress. Congress doesn't have to approve it. They don't even get to say, they could say something about it, but it's essentially the phase one trade deal is done. So what's happening is the bulk of the tariffs are staying in place. There was a reduction in tariffs, and the tariffs will stay on at least through the election. China's obligation is to increase their purchase of a variety of goods from us, and then that number goes way up next year. So their goal for this year is more than they've been doing, but not nowhere near as much as they're going to have to. And if we decide to increase the tariffs, they have agreed not to retaliate, but have a mechanism they can back out of the entire deal. Now, if those of you that have lived or worked in China, then you know, or know someone that has, they negotiate completely different than Americans do. When Americans make a deal, right? Shake hands. We believe that both parties are going to do what they said they're going to do. In China, the real negotiating doesn't begin until something is signed. And now we've got something signed. So we'll see kind of how that all plays out. What was very interesting is stocks kind of had a muted response to it, and interest rates went down. A deflationary response. Now you have to understand that we should expect a deflationary response from the market, because when you understand the world dollar liquidity cycle of how money moves through the global economy, it's our role as the world's reserve currency to export jobs. I understand that a lot of people want jobs back, and I do too. From an economic standpoint of how the dollar works as a reserve currency, it is our goal to get rid of as many jobs and send them overseas. That's why we send manufacturing jobs, and we send services jobs, and we send programming jobs, and we send everything we can, because when they get those jobs and that work comes back, they receive dollars. So these foreign countries, foreign workers receive US dollars, and those dollars get recycled back into the US economy when they buy government debt. And much like a giant cannon, when the government borrows and spends, it just shoots money all over the place. That's the world dollar liquidity cycle. And when you force a trading partner to circumvent that by going directly back and buying a specific amount of goods from us rather than letting them determine the right level, it means less money is going to, foreign money is going to buy government debt. And at the end of the day, that means Americans will be forced to buy our own debt. And guess what we really don't like doing? We don't like debt. We like risk. That's why Americans prefer to buy stocks over bonds. And that's why the Fed is scrambling. That is why part of the reason why we have this dollar liquidity problem. It's not just because of the issue with China. The main issue there is obviously the Fed contracting world dollar liquidity and destroying dollars by tightening monetary policy. But this is not exactly helping in that problem. So why is the Fed panicking? Because they're trying to absorb all the debt. Because if they can't, and they can't do it all, then that means Americans have to. And when Americans start buying our own debt, that means less money goes into risk assets and other ventures, and the economy slows down. Now, I want to spend some time today looking at today's economic data, and then we'll get into a few charts and see what's going on from a chart perspective. But I want you to look at the data as I look at it. And a lot of times as investors, we look to other people to tell us, okay, what does that mean? How, I don't understand it. Well, I want you to step beyond that. I want to educate you and say, okay, look, here's the data. Here's what it means today, but here's the bigger picture. So let's start by looking at the mortgage data. Now, I'm at investing.com. If you're wondering how I got here, I went to investing.com, and under news, there's something called the economic calendar. And every day they update what is going on in the world. And as things happen, with the exception of a few foreign countries where the data doesn't come in right away, you get to see what the news is, what the reports say as it happens. So this morning at 4 a.m., the mortgage data came out, and the MBA mortgage application shot up 30% over last week, which is really quite impressive because we've been seeing a slowdown in the mortgage data. Now, purchases increased, but what's really interesting is the refinance index just shot off the chart. So let's talk about what this means, because the initial response to this is, oh my God, that's inflationary. Interest rates are going to go up. Not so quick. Let's go through it. So the first step is purchase index is new mortgages. So if I go out and buy a brand new home and I get a loan on it, that's creating new money into the economy. So you got to think about that. How is money created? When someone takes out a new loan. Now let's say I buy a house from you, your house, and you move. The assumption is you're not going to be homeless. Now, maybe you're downsizing and who knows what's going on, but you're going to take your equity or whatever you've got and go buy another home. So you're going to get a new mortgage. I'm getting a new mortgage. And then new money is created out into the economy. So when you see a huge surge in new mortgages, that would be interpreted as inflationary. Now, you can look at this a little deeper. You can click on the mortgage purchase index. It'll open up a whole new window. And down here you say, well, look, it's rising. It's all relative. Go look at where it was back in the housing bubble. So yes, is this big jump here pretty big? It is, but I'm also hearing people say due to Christmas and New Year's falling on Wednesdays that a lot of things got pushed back into January. So that's the first thing we look at is the mortgage purchases. But it's the refinances that are really telling us something interesting. And you see a huge jump from 1,700 on the index to 2,444. So let's interpret how that works. So let's just say I have a 20-year mortgage or 20 years left on my mortgage. Let's just pretend that I do. Now, from a bank's perspective, so step back and say, okay, now as a bank, I have to post collateral against that mortgage. Now, how do I do that? Well, I'm going to take a blend of, say, probably some 10-year, treasuries and some 30-year treasuries, and boom, I'm going to get an effective duration of 20 years between those two bonds. Now, I'm going to adjust that from the bank's perspective. As that mortgage gets paid down, I'm going to adjust that and move away from those 30-year treasuries as my collateral and get shorter and shorter term debt. Because if you think about it, where is the risk for a lender? Is it the first day of the 30-year loan or the last day? It's the first day, because if the person defaults, the lender has got to go repossess a house, resell it. They're probably not going to get much of their money back. But on the last day, what if someone defaulted on their very last payment? Well, banks got no problem getting their money back out of that. So what does it mean why is an increase in refinances very bullish for 30-year bonds? Okay? Now let's go back. I got a 20-year mortgage. When I refinance, why do most people refinance? Are they refinancing to get a lower rate? Well, rates have been fairly steady for the last several years. And the rule of thumb was they have to drop 2% to really refi your payment down. So that's not it. Well, the reason most people refi is to cash equity out. And somewhere around 80% of all refinances are cash out. So from a bank's perspective, I just went from a 20-year loan to a 30-year loan. And what do they have to do? Well, they have to get rid of their shorter term treasuries that they don't need to back that loan, and they need to get 30-year treasuries. And all of a sudden, what did we see last week? So I want to tie this back to what we saw last week. We saw fairly mediocre, I think a 3-year, 10-year auction, and then all of a sudden a lights out 30-year auction. Why is that? Because the data right here said there's a bunch of people cashing out equity and going to new 30-year loans. At least we can interpret that. Now, why might that be? Well, we just left the holiday season, did we not? People spent a lot of money. The retail sales data, which is due out tomorrow, should indicate that sales were up. We know the same store sales from Redbook were up. So what does that mean? It means people were hoping the economy was getting better as they spent their money, and it's not. That's what it means. And how do we know that? We know hours worked are falling. We know pay is not increasing with inflation. So we know. So why would people cash out equity, pay out the credit cards, or pay down? Would make sense. Now let's look at some other evidence of a slowing economy. We have the crude oil data. So here's crude oil inventories. You see last week, the forecast and actual. So from just looking at crude oil inventories, they dropped 2.5 million barrels. So that was really good from if you're just looking at that. But when you go down and look at let's see, where are distillates? Here, distillate stocks. They built 5.3 million last week, or the week before, 8.1 million this week. So distillate stocks are going up. This is jet fuel, diesel, and if you can go look at a chart, they're running pretty high up there. And we're not getting this number due to overproduction. Last week, distillate fuel production was down. So let's take a look at gasoline inventories. Last week's 9.1 million barrels. This week, 6.6 million barrels. Gasoline production up 394,000 barrels. So what are you seeing in the oil data is you're seeing weak demand. So that's what's nice about some of this weekly data is you see this demand is slowing. So does it make sense why people might refi? Does it make sense now why there's a demand for 30-year loans or 30-year paper, treasuries? Because the federal government is issuing most of their debt in shorter-term 1-year treasury or less treasury bills. So the supply of 30 years is low. That's why I want to be invested in them. Now, there's something else before we get to the charts I want to quickly look at is the Cass Freight Index. On a year-over-year basis, this had the largest drop since the great financial crisis. Of course, there's the Cass cites that, hey, that's due to the Christmas and New Year's falling on a Wednesday, that we expect this to pick up. But when you see shipping falling, what does that mean? Well, it means the economy is slowing because people and corporations and businesses are buying less stuff. But one thing that I found really interesting in this report is inventories. And for the longest time, I've been trying to find something that told me where were inventories at. And I don't know why their chart is blurry, but it says business inventories, and that would be in gray. And you can see from the great financial crisis, inventories were ramping up. They went down, and now look, inventories are way up here. So it kind of tells me that business inventories are way too high, and this will be a problem that shows up in the future. Okay, so let's take a look at Treasury yields, since that is kind of the big interesting thing that's going on. We see after touching support, where these two solid purple lines are at, speculators drove yields higher, ran right into resistance where it had been previously, where buyers are at, and then buyers have been pushing yields down. And now we closed a little bit below we're here. So we're right just kind of in between these two purple lines and some heavy support right down here. So my expectation is we should see yields continue to fall. Now, speculators have been pushing against that. And the easiest way to look at that is symbol TLT, which is the largest 20-plus year Treasury bond ETF. It's the most broadly traded. You see today traded 6.2 million shares. Yesterday, there was $1 billion of inflow into this ETF. $1 billion of inflows. So today, when you look at the chart, you can see it started the day, went down, went up, went down, up and down. But you see it finished fairly strong, and it didn't finish on some super high volume. And what you're seeing here is the sellers who you can see here have been running out of steam. So the volume, you can see trading volume is declining as sellers get weaker. And now all of a sudden prices are rising because there is a demand and sellers are running out of steam. So what you're seeing the beginning of is a short squeeze where people who were selling here are going to be forced to turn into buyers if this continues. So they're trying to sell it down, but the market is just moving it up. And so you have a lot of selling pressure here, and up here that will get unwound as this thing moves higher. That is what's called a short squeeze. So this triangular pattern can either break down where you run into people selling, or it moves higher. And remember, the key to this thing moving higher was that 30-year Treasury auction, and now that's validated by the mortgage refinances. Obviously, the banks would know that, and then you look at the crude oil data and say, well, if gasoline and distillates are building, is that inflationary? No, it tells you there's a demand issue, and when demand goes down, interest rates go down and bond prices go up. And here you can see, looking at ETF symbol XOP, the oil and gas producers falling just below this level of support here. Now you see there's these candlesticks are showing people are trying to buy this up because there's a lot of long speculative interest in oil, but this is looking like it's heading lower. And the fact is, if you think about the oil data, if you get, you're not supposed to be getting big builds during the holiday seasons because people are supposed to be traveling and spending money. So what do you think is going to happen to gasoline and distillate inventories, just assuming that crude oil doesn't build? What do you think is going to happen over the next several months, absent any big holidays or summer driving season? They're going to build. And that means there'll be more layoffs. Plants will get throttled back. Interest rates will go down. The economy is slow. And that big Treasury short squeeze will bring the stock market to its knees. I'm Steve Van Metre. I'll see you Friday. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation by or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.